First, welcome to our deep dive on the Municipal Bond Duration Trap. Today we will unpack why tax-free yields can be enticing yet surprisingly risky, especially for short-term goals. We will highlight how duration drives bond fund volatility, and we will give you a clear decision framework to match your time horizon with the right instruments. Next, here is our agenda. We will begin by comparing tax-free and taxable yields. Then we will explain the role of duration and why it matters for volatility. After that, we will examine the volatility shock when interest rates rise. Subsequently, we will show how to match your goal horizon to fund duration. Then we will compare safer short-horizon alternatives and provide a step-by-step action plan. Finally, we will reinforce the learnings through quick quizzes. Then, before we chase yields, we should recognize that municipal bonds can be tax-advantaged, yet still carry interest rate risk through duration. This mind map shows three pillars: tax benefits at the federal and sometimes state level, risks such as duration and liquidity, and time horizon considerations. Crucially, short-term goals should not be funded with intermediate or long-duration funds because price sensitivity to rates can be significant. Moreover, let us clarify the yield math. If a taxable bond yields 4% and your federal tax rate is 32%, your after-tax yield is 4% times 1 minus 0.32, which equals 2.72%. Therefore, a tax-free municipal bond yielding 2.72% offers the same take-home income. More generally, the after-tax yield equals taxable yield times 1 minus the tax rate, while the tax-equivalent yield equals the tax-free yield divided by 1 minus the tax rate. Furthermore, duration is the measure of a bond fund's sensitivity to interest rate changes. As a rule of thumb, the price change is approximately the negative of modified duration times the change in yield. For example, if a fund has a 6-year duration and yields rise by 1 percentage point, the fund's price can decline by roughly 6%. Intermediate municipal bond funds commonly carry durations around 6 to 10 years, which can introduce significant short-term volatility. After that, consider the volatility shock observed during rate hiking cycles. Intermediate duration bond funds have experienced declines of 10 to 20% or more when rates rose rapidly. These losses can easily erase years of tax benefits for investors with short-term goals. Importantly, these drawdowns are typically not due to municipal defaults, but rather to interest rate risk via duration exposure. Consequently, align your instrument to your time horizon. On the left, for horizons of 2 years or less, favor liquidity through government money markets or high-yield savings. For horizons up to 3 years, consider short-term municipal funds with low duration. You can also consider defined maturity date funds that wind down at a set date to mimic the hold-to-maturity experience. On the right, avoid pairing goals due in 1 to 3 years with funds carrying 6 to 10-year durations. Avoid chasing yield when you need principal stability, and avoid betting on interest rate direction for short-term needs. Meanwhile, this table summarizes safer short-horizon choices. Short-term municipal funds typically hold bonds with 1 to 3 year maturities, providing lower volatility and potential tax advantages. Defined maturity date bond ETFs wind down at a known date, giving clearer cash flow for a specific goal, though prices can fluctuate before maturity and there is reinvestment risk when the fund matures. Government money market funds and high-yield savings offer very short duration and high liquidity with low volatility, though returns are taxable and yields can change quickly. Subsequently, use this action plan. First, define your specific goal and deadline. Next, identify the duration statistic of your current holdings. Then, estimate rate risk using the price change approximation. Negative duration times the change in yield. After that, compare tax-free municipal yields with the after-tax yields of cash alternatives. Then choose the instruments that align with your time horizon, such as cash, short-term municipal funds, or defined maturity date funds. Next, set a rebalancing and contribution schedule. Finally, document your exit plan and target date. Then, the timeline diagram will map the journey from defining your goal to execution and finally redemption at the target date. It begins at month 0 with goal definition, proceeds in the first month to auditing holdings and noting duration, and by months 1 to 2 compares tax equivalent yields against after-tax cash yields. At month 2, you select the appropriate instruments. At month 3, you implement and set a rebalancing cadence. From month 3 to the goal date, you monitor rates and duration drift. At the goal date, you redeem and fund the objective. Next, here is a quick question. Your goal is in 18 months. Which instrument is most appropriate? Option A is an intermediate duration municipal fund with duration around 7 to 8 years for higher yield. Option B is a short-term municipal fund with low duration. Option C is a leveraged long-duration bond exchange-traded fund. Option D is a speculative rate bet with derivatives. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Afterward, the correct answer is Option B, a short-term municipal fund with low duration. For an 18-month objective, stability of principal takes priority over maximizing yield. Longer duration or leverage strategies introduce unnecessary interest rate risk for such a short horizon. Next, consider a second question. A municipal bond fund has a 7-year duration. If yields rise by 1%, what is the approximate price change? Option A is -7%. Option B is -1%. Option C is +7%. Option D is 0%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Then, the correct answer is -7%. By the standard approximation, the price change equals negative duration times the change in yield. With 7 years of duration and a 1% increase in yields, the estimated price change is approximately -7%. Additionally, remember these key points. First, tax-free does not mean risk-free, because duration drives price volatility. Second, always match the instrument's duration to your goal horizon. Third, for horizons under 3 years, consider low duration or defined maturity options. Fourth, younger investors may prioritize growth assets over tax-free bonds due to opportunity cost. Fifth, always compare tax-equivalent yields against after-tax cash yields. In addition, this video is for educational purposes only and does not constitute financial, tax, or investment advice. Your situation is unique, and you should consult a qualified advisor to evaluate the appropriate strategy for your circumstances. Finally, let us wrap up. Tax-free yields can sometimes mask the underlying duration risk in bond funds. Short-term goals should be paired with short-duration or defined maturity instruments. Always run the math and prioritize principal protection over marginal yield. To conclude, thank you for watching. If you found value in this video, please like, share, and subscribe. Share your thoughts and questions in the comments, including your time horizon and how you are aligning duration with your goals.